Scope of UK capital gains tax. Capital gains tax is charged when a chargeable person makes a chargeable disposal of a chargeable asset. A chargeable disposal can be sales, part disposals, gifts of assets. However, transfers upon death are exempt and is dealt with under inheritance tax. The inheritor of an asset uses the market value at the date of death, which becomes the new base cost. All forms of property are considered chargeable assets unless specifically exempt. Key exempt assets include certain chattels, cars, and UK government gilts. An individual's liability to capital gains tax depends on their UK resident status for the tax year based on residency rules. For example, a person may be treated as resident if they spend 183 or more days in the UK during the tax year, have their only home in the UK, or carry out full-time work in the UK. Those with significant UK ties may also be deemed resident. Basic computation. For individuals, the basic capital gains tax computation involves adding the original purchase cost plus any enhancement expenditure that added value, plus incidental costs, such as legal fees, and deduct the total from the disposal proceeds to arrive at the chargeable gain. The annual exempt amount of £5,000 is then subtracted to determine the taxable gain. Note the difference between chargeable gain and taxable gain: one is before deducting the annual exempt amount, and one is after. Repairs do not count as enhancement expenditure, as they do not increase the asset's value. Capital losses. Capital losses incurred in the same tax year are offset against chargeable gains before deducting the annual exempt amount. This can sometimes result in wasted losses if the gains would otherwise have been covered by the exemption. Unused losses can be carried forward to future years, where they are deducted from gains after the annual exempt amount has been applied, so carried forward capital losses are not wasted. Rates of capital gains tax. The rate of capital gains tax depends on the taxpayer's income level and the type of asset sold. For most assets, gains are taxed at 10% if they fall within the basic rate tax band and 20% for gains exceeding this threshold. However, gains from residential property that do not qualify for private residence relief are taxed at higher rates of 18%, basic rate, or 28%, higher rate. Business asset disposal relief offers a reduced rate of 10% on qualifying gains, subject to a £1 million lifetime limit. This applies to disposals of business assets, such as shares in unlisted trading companies or sole trader assets, provided certain conditions are met for at least 2 years prior to disposal. Payment on account for residential property. When disposing of residential property, a payment on account must be made to HMRC within 60 days of completion. This payment is calculated based on the estimated tax due, taking into account the annual exempt amount, any current year losses incurred before the disposal, and brought forward losses. The taxpayer must also estimate how much of their basic rate tax band will be available for the year. Any adjustments for other gains or losses later in the tax year are accounted for in the final self-assessment return following the tax year. The payment on account for residential property already paid can then be deducted from the final capital gains tax bill when completing the self-assessment. Reliefs. Several reliefs can reduce or defer capital gains tax liabilities. Private residence relief exempts gains on a taxpayer's main home if it has been occupied throughout ownership, with additional exemptions for the final 9 months and certain periods of absence. Letting relief reduces capital gains tax when selling a home that was partly rented out, but only if the owner lived in the property at the same time. It applies alongside private residence relief and is capped at the lowest of £40,000, the private residence relief amount already claimed, or the gain attributable to the let portion. Importantly, it does not apply if the entire property was rented out without the owner living there. Rollover relief allows deferral of gains if proceeds are reinvested in qualifying business assets, such as land or machinery. Gift holdover relief defers gains on gifts of business assets, such as shares in unlisted companies, by reducing the recipient's base cost. Investors' relief offers a 10% rate on gains up to £10 million for external investors in unlisted trading companies, provided shares are held for at least 3 years. Special rules. Special rules apply to certain assets. Chattels, which are tangible movable property, are exempt if they are wasting, meaning that they have predictable useful life of 50 years or less. For other chattels, they are exempt from CGT if sold for £6,000 or less, and the original price was lower. For sales between £6,001 and £15,000, the gain is capped at 5/3 of the excess over £6,000. For chattels sold for more than £15,000, normal capital gains tax rules will apply with no cap. If sold a non-wasting chattel such as an antique or painting for less than £6,000 and at a loss, the allowable capital loss is restricted. HMRC treats the sale proceeds as £6,000 instead of the actual amount received. For a chattel used in a business and capital allowances were claimed, the normal exemption rules for chattels do not apply. Instead, any gain on disposal is fully taxable. And if sold at a loss, no capital loss is allowed, since tax relief was already given via capital allowances. For example, if a business-owned camera, eligible for capital allowances, is sold for a profit, the full gain is subject to tax, even if sold for under £6,000. For shares, disposals are matched with acquisitions in a specific order. First, match disposal with same-day purchases of the same share, then acquisitions within the following 30 days, and finally, the share pool. Transfers between spouses or civil partners are made at no gain and no loss, with the transferee assuming the original cost base. Capital gains tax for limited companies. Limited companies incorporate chargeable gains into their taxable total profits, with no annual exempt amount. They benefit from an indexation allowance, which adjusts the purchase cost for inflation up to December 2017. Capital losses are offset against gains in the same accounting period or carried forward, but they cannot be set against other income. Planning tips. Effective capital gains tax planning involves utilizing the annual exempt amount, allocating losses to higher rate gains, and spreading disposals over multiple tax years or between spouses to optimize tax rates. Delaying a disposal to the next tax year or splitting a disposal across 2 years can maximize reliefs and lower rate bands.